So here's an article by Realtor.com. Borrowers will find it harder than ever to get a mortgage this spring. Here's why. And they're talking about how it's a very mixed bag because interest rates are at the lowest point that they have been in history, which is spurring a lot of people to refinance their homes. And it is also encouraging buyers that have been priced out of the market or have been losing out to other buyers. Since there was a lot of multiple offers, it was a very, very competitive buyer's market for quite some time. Because of the interest rates, they have more buying power, and it's encouraging them to get into the market. But the issue is, or one of the issues that we're facing, is that lenders are very aware of what happened in the financial crisis of 2007. And as workers are getting furlonged and pink slipped, lenders are deciding to take an extra cautious approach, and they're raising credit scores in many cases, and they're also raising the down payments. They're being much more careful when it comes to jumbo mortgages, and that's why a lot of buyers are going to find it very tough to purchase, even if they have a good job right now and they want to move forward. So we're going to take a look at all the different loans out there: conventional, FHA, farm loans, and kind of just take a look at what is happening with each specific loan category. And then we'll talk about what this means for the market in general. So before, though, we get into each individual type of mortgage, we're looking right here where it says the Mortgage Bankers Association Mortgage Credit Availability Index dropped 16.1% in March, and now it is at its lowest level that the index has been since mid-2015. And obviously, the more people that are able to get mortgages, the more home sellers that are in trouble are able to sell, and we can move people that have jobs and have stable income into the homes and potentially allow people that have lost their jobs or are now struggling to access their equity and get out of the home. So very important to have access to mortgages, especially for those people that are actually a lot more credit worthy than some of the people that are currently in the homes. And this is going to be a big problem, and it's something that the government is trying to solve, and we'll see how they do. I mean, I have a feeling it's going to be a tough road to go down for the government. So here's a chart for the Mortgage Credit Availability Index, and we can see it's at 133 right now, and that is down substantially. Again, we said approximately in 2015 is the lowest point that it was up to now. So it kind of skyrocketed, as you can see, where the availability of mortgages was much more accessible in recent years. And again, that was part of the reason that the home prices, started going up to pre-2006 levels. And right here, you can kind of see back to 2011, where home prices, where mortgage index availability was very, very low, right about 90. And then let's, just for perspective, let's take a look at where the mortgage availability levels were in 2005 and 6 and 7. They started coming down at 7, but you can see in February it was essentially through the roof, almost off the chart here, where they had ninja loans, which, if you're not familiar, ninja loans were no assets, no job, no income, and you just simply stated how much money you wanted to borrow, and the lender just said, no problem, we can make it all up for you and get you into any home that you want to be in. which was shocking for me when I first got into real estate, because this is what was happening, where I had somebody that had, they did have a job, but they had very low income, and my lender was saying, don't worry about it, just tell me what they want to purchase. And being somebody who's always kind of stayed within my means and always only bought what I was very comfortable with, what I could afford, this was kind of shocking to me. I didn't put it all together at that time, like many didn't, but it definitely was a red flag that things were not going to end very well at the time. So it's not surprising, though, that the lenders are concerned, because according to the Mortgage Bankers Association, 7% of mortgages right now are currently in forbearance as of April 19th. And there is definitely expected that there's going to be quite a few more foreclosures after the main mortgage forbearance period is up, which now for government loans, which is Freddie Mac and Fannie Mae, is 12 months. So there's going to be no foreclosures before 12 months, but the Freddie Mac and Fannie Mae hold the vast majority of loans in this country. So after 12 months, they're going to have to decide what they're going to do. And I would assume at some point they're going to have to foreclose on these people if there is not a way for them to come up with the money they owe. Or we're going to have to go into loan modifications. But I know in the last financial situation that we had, in the last financial real estate crash, I should say, that the government and the lenders were not very accommodating to help people to stay in their homes. I mean, the vast majority of the help that they finally did give to homeowners after several years of just straight foreclosures was when they started helping people short sell. So that meant that they were able to sell their home and in many cases be forgiven for the excess of what was still owed compared to what the home would sell for. But even fewer people, or very few people, got to modify their loans and stay in the homes. So it just seemed like at the time that the bank wanted the consumer to feel the pain of not making their mortgage and at least have to move out of the home, which obviously led to a lot of frustration with homeowners at the time. Occasionally, not all the time, but a lot of times you'd walk into a house and you'd see hammer holes in the wall, or you see spray paint. You'd see the signs that the previous owner was not very happy about the current situation. So the bank again wanted to make the pain point pretty high for those people. I think to set the precedent that, hey, you have to pay your mortgage, even though they were largely responsible for lending money on these ninja loans that I was talking about. So Javier Vivas, who is Realtor.com's Director of Economic Research, is estimating that about 5 to 20% of prospective borrowers could have trouble getting a mortgage due to higher standards. Now, a lot of people are complaining that this is not fair to buyers that have always been making their payments and have good credit, because now they're going to be punished because of other economic factors that are out of their control. But that is what's happening right now. So he's also saying that he expects those numbers could easily get worse as the recession worsens and unemployment could rise and top 20% in some of the worst case scenarios. And this also is being taken into consideration that salaries are potentially going to fall, bonuses might not be there, overtime pay, and then also the gig worker economy, people that are setting up for concerts, plays, people that do part-time work, but they get paid pretty well when they're out there working, but those things have all been affected. So he's saying that potentially the 5 to 20% of prospective borrowers that could be affected could actually go up as, again, the economy worsens. And these borrowers that are looking to get loans, they're being affected very quickly. So if someone was actually pre-qualified at the beginning of the year and they still just hadn't found a house yet, they could now not qualify for a home loan because the credit score in the beginning of the year was 580 and sometimes even lower. And now, and that's for federal housing administrative loans, VA loans, and U.S. Department of Agriculture mortgages. And now the credit scores are typically starting between 640 and 680. Then it goes on to say that JP Morgan Chase borrowers will now need a minimum credit score of 720% down. I guess there is an exception to this. It's the Dreammaker program targeted towards low and moderate income and first-time home buyers with low credit scores and down payments. Definitely would need to refer you to my lender to talk about those programs if they are still indeed available. And it says that mortgage company was the fourth biggest mortgage lender in 2009, according to Inside Mortgage Finance. So Chase Bank is saying that due to the economic uncertainty, that they just want to focus on their current customers, which is a really nice way of just saying that we are very, very concerned right now, and we probably don't want to take on additional debt from borrowers who are going to end up defaulting on their loans. So as we can see here, other lenders are being affected and raising their credit score requirements too. The Flagstar Bank and Better.com also have raised their scores. And Flagstar is now asking for a 660 credit score for FHA loans and 680 on VA and U.S. Department of Agriculture loans. Better.com is asking for a minimum of 680, and it was previously at 640. And this is nothing surprising. I mean, these are just two examples, but this is happening all throughout the lending industry. In addition, it's also saying that during the crisis, Navy Federal and Better.com have temporarily stopped lending to FHA loans altogether. So they really don't want to take those high-risk loans. FHA is only 3.5% down. So it's going to take a while for those homebuyers to build equity, which actually ensures the bank's ability to foreclose and actually not lose money. Now, obviously, the banks are charging PMI, private mortgage insurance, to the borrower. So assuming that some of them are going to default, they can typically make it up on the PMI that they're charging everybody. But in this case, they're saying that the rates of forbearance or people that are not making their payments could be so high that they just want to discontinue FHA loans altogether right now. Also being drastically affected is the jumbo mortgage market. So jumbo starts at 510 and goes up to 765. So a bigger problem for other places like San Francisco or Seattle or many other states around the U.S. For us, it's not quite as big of a problem unless you're in one of those homes that is going to require a buyer to get a jumbo loan. But our medium price, where half of the homes being sold are lower than and half of the homes being sold are higher than, is right around 315 right now. So obviously it is affecting us, but not as harshly as it is affecting other states right now. Now, the main reason that a lot of lenders are holding back on making these jumbo loans is because it's much harder for them to sell those loans to other buyers, which frees up extra cash that they're allowed to lend to the next person that comes along who wants a loan. and then make money on the lending process, because when you buy a home, if you buy with cash, your closing costs are approximately 1% of the loan of the home's value, and it's typically more around 3% if you're purchasing with a loan. And most of that cost comes from the lender origination fee. So they want to limit the jumbo loans that they're going to get stuck with, so they can at least continue to get those origination fees as they do loans and sell the loans off to the government or to the secondary market, where they package those loans up into securities and they sell them to Wall Street. So as we mentioned, gig workers are being affected because typically these are non-conforming loans. These are loans that are hard to sell back to the government. They don't meet regular FHA guidelines. So most of these people have to show pay stubs instead of a W-2 from a regular employer. So these are considered high-risk loans. It's definitely considered that a lot of these people potentially are going to make less money in the near term as social distancing continues into the future, which is obviously uncertain exactly how long that's going to last. So a lot of lenders are only accepting 70 to 80% of what these gig workers have made in the past few years, assuming that they are going to end up making less money. And they're also charging higher fees to these people in anticipation that a lot of them will potentially end up going into forbearance and not making their payments. So they have to charge higher fees up front to make up for anybody who does go into forbearance. And it is kind of a backhanded way to more or less say, hey, we don't really want to do your loan right now. So the other thing that's going on right now is lenders are doing additional income verification. Before coronavirus, most lenders were just checking at the beginning of the loan if the person was employed. Now they are waiting till sometimes 10 days before the loan is about to close. And in some cases, they're actually calling the very day before to make sure that person is still employed. That is just something that was really not done that often. They weren't calling on the last day to verify the loans, at least not on a regular basis like is what's happening now. So at this point in the article, they're talking about a couple that was in escrow. The wife had lost her job. The lender called to verify at the last minute, found out she had lost her job, and they almost weren't able to get the loan done, even though she had been taking on consulting and another position. They would not use that income because she had not been doing it for 2 years, and they said that she was not fully established in that business. So they ended up raising the down payment. So using the money out of their 401k, they were able to come up with the additional money that the lender was requiring in this case, which was 40% of the purchase price. Now, just for anybody who's really motivated and wants to buy a home right now, I personally think it's a good time to sit still and wait. But if you are really motivated and you do want to purchase a home right now, the IRS is now allowing you to take, it says lawmakers, but I assume it's the IRS. The way this reads, lawmakers are allowing individuals to take up to $100,000 of their 401k, and they have 3 years to repay that money before they are going to be facing the typical early repayment withdrawal penalties. What does this all mean? In my opinion, it means that you probably should sit tight. If you're looking to purchase a home, you probably want to wait at least 6 months to a year and kind of just see how this situation unfolds. It could be actually vastly longer than that, because some people say, oh, there's great deals on the way down, and that might be true to some extent, But in my personal opinion, you should not buy on the way down because you just don't know how deep the situation is going to get. Where, in my personal opinion, it's easier to just watch things as they're going down. And then when you see some economic good news happening, you see home prices start to rise again. You see inventory start decreasing, and you see the trend start going up, that prices are improving, unlike the stock market where they expect this massive V-shaped recovery, which I don't personally think is going to happen either. But real estate is a much slower moving vehicle, so you have time. So even if you don't grab something at the very bottom of the market, typically in these cycles that last 6 to 10 years, if you start seeing things coming up, in a year or even two, and then you decide, hey, it's safe to jump back in, you still have another 6 to 8 years typically of appreciation. And then if you're an investor, obviously you want to be looking towards the top of the market to get back out, unless your properties are paid down and you know that you have a cushion. So if something like this happens, you either have money in the bank so you can continue to make your payments, or your rent is so low that you can potentially find tenants that are still working and that still can afford their rents. I mean, obviously this situation is unforeseen, and it's very different than than downturns we've seen in the past, because the government is not allowing any evictions as of right now. But typically, you could, evict the tenant, and I know that's unfortunate, but at the same time, a landlord obviously has to protect their investment. They're providing somebody with a place to live. They're doing all the maintenance. They're taking the risk by owning the home. So definitely, I believe personally that obviously the landlord should have the ability to get that tenant out of the home if they're not paying, because essentially you can't have the person who's actually providing the home to somebody and taking all the risk also suffer financial consequences because the tenant is unable to pay. So that just means now two people are hurting rather than one. And actually the chain is much bigger than that. Obviously you have mortgage servicers, the lenders, the property values in the community, and it goes on and on. But that's a subject for another time. But anyway, hopefully you kind of get an idea of what's happening in the mortgage industry right now. And I'll keep updating you with these videos. Hopefully you enjoyed it. If you did, please subscribe to my channel, of course, and give me a thumbs up, or give me a comment, or if you have any questions about what's happening in the mortgage industry, let me know in the comment section, or reach out to me. You can give me a call or email me. My phone number is 702-809-5734. Email is kblumberg @gmail.com. Again, thanks for watching, and I'll look forward to talking to you soon.